I did everything right for 10 years. My index fund still lost money. Here's why. I want you to think about the last time someone told you to just buy index funds and chill. Maybe it was a YouTube video. Maybe it was your coworker at lunch. Maybe it was some finance influencer with a ring light and a whiteboard. And they weren't lying to you. Not exactly. But here's what nobody told you after that advice. In the year 2000, a 35-year-old American put $50,000 into a standard S&P 500 index fund. He did everything right. He didn't panic. He didn't sell. He held. By 2010, 10 years later, he had less money than he started with. 10 years. Zero gains. And inflation had quietly eaten another 28% of his purchasing power on top of that. He didn't buy a bad stock. He didn't make a dumb gamble. He bought the thing every expert told him to buy. So today we're going to talk about what they forgot to mention. Welcome. If you're new here, this channel is about financial truth, not hype, not get-rich-quick schemes, just the honest picture that most people don't get until it's too late. Today's topic is index funds. And I want to be crystal clear before we go any further. Index funds are not bad. I own them. A lot of smart, wealthy people own them. They are genuinely one of the best financial tools invented for everyday Americans. But a tool is only useful if you know how it actually works, including where it breaks. Right now, millions of Americans are walking around thinking their index fund is a set-it-and-forget-it retirement machine that basically can't fail. And that belief, that specific overconfidence, is quietly setting a lot of people up for a very rude awakening. We're going to cover 5 specific ways index funds lose money that almost nobody explains clearly. No jargon. No charts you need a finance degree to read. And at the end, I'm going to give you a simple 3-question test to figure out if your current index fund strategy actually has a blind spot. Let's get into it. The safe bet that quietly became a concentrated gamble. Here's a question I want you to really sit with. If I told you that you could put your money into a fund that holds 500 different companies, 500. You'd probably feel pretty good about that, right? Spread across hundreds of businesses. No single point of failure. Diversification at its finest. Now what if I told you that buying the most popular S&P 500 index fund today means that roughly 35 cents out of every dollar you invest goes into just 7 companies? 7. Out of 500. That's not a typo. Apple. Microsoft. Nvidia. Amazon. Alphabet. Meta. Tesla. These 7 companies, sometimes called the Magnificent Seven, have gotten so astronomically large that they've essentially taken over the index. And because index funds are built to follow the market's weight, the bigger these companies get, the more your index fund is forced to buy of them. Here's the trap. The S&P 500 isn't 500 equal slices of the American economy. It's a popularity contest where the biggest kids keep getting a bigger seat at the table. And you, as the passive investor, have no say in it. Think about it this way. Imagine you ordered a pizza from a place that said 500 topping supreme pizza. Sounds incredible. But when it shows up, 35% of the pizza is just pepperoni. Like, aggressively, overwhelmingly pepperoni. The other 493 toppings are all crammed into the remaining 65%. That's your index fund right now. And this isn't just a theoretical concern. Back in 1999 and 2000, the same thing happened with a different set of companies. Cisco Systems alone made up over 4% of the S&P 500 at its peak. Then it dropped 86%. If you owned the index, Cisco dragged your entire portfolio down with it, even if you had zero interest in Cisco specifically. Here's the uncomfortable question this raises: are you actually diversified, or do you just feel diversified? Because those are 2 very different things. The fix isn't necessarily to abandon your index fund. But it might mean looking at something called an equal weight index fund, where every company gets the same slice, as a complement to your regular holdings. More on practical moves at the end. The invisible tax nobody warned you about. This one is quiet. It doesn't show up as a red number on your brokerage app. There's no news alert about it. But it might be the single most damaging force working against your index fund returns over a lifetime of investing. It's called inflation. And I don't just mean inflation in the abstract, prices go up, sense. I mean the very specific, very real way inflation can make your index fund look like it's winning when it's actually losing. Here's a scenario. You invest $100,000 in an index fund. Over 10 years, it grows to $118,000. You've made $18,000. You feel pretty good. But during those same 10 years, inflation ran at about 3.5% per year. That means the actual purchasing power of your $118,000 is equivalent to roughly $84,000 in today's money. You gained $18,000 on paper. You lost $16,000 in real life. This is exactly what happened to millions of Americans during the 2000s. The lost decade. The S&P 500 delivered essentially zero nominal returns between 2000 and 2010, and when you factor in inflation, the average investor actually went backwards. A decade of dutiful investing. A decade of waking up earlier, working harder, skipping vacations to save more, and ending up with less purchasing power than when they started. And here's the thing that makes this especially dangerous for average Americans: inflation doesn't hit everyone equally. If you're close to retirement and your expenses are heavily weighted toward healthcare, housing, and food, categories that consistently inflate faster than the average, your safe index fund might be running just to stay in place. An index fund is not an inflation-proof vehicle. It's a bet that American corporate earnings will outpace rising prices over the long run. Most of the time, that's a good bet. But, most of the time, is cold comfort when you're in the middle of a decade where it doesn't work. The smart move. A pure stock index fund shouldn't be your whole retirement picture. Real estate investment trusts, commodities exposure, treasury inflation-protected securities, these are the kinds of assets that can hold their ground when inflation runs hot. Most plain vanilla index funds have almost zero exposure to them. The moment your passive fund becomes someone else's opportunity, want to tell you about a mechanism inside the market that most retail investors have never heard of. And once you understand it, you'll never look at a market crash quite the same way. It's called forced selling. And it's the real reason market crashes go from scary to catastrophic. Here's how it works. A lot of professional investors don't just invest their own money. They borrow money from banks to amplify their positions. This is called leverage. When things go well, leverage multiplies their gains. But when the market drops, it multiplies their losses even faster. So let's say a big investment firm borrows $500 million to invest on top of their own $200 million. They control $700 million in the market. If stocks drop just 10%, they've lost $70 million, a third of their own money. The bank calls them and says, "Pay us back, or we're selling your positions to protect ourselves." The firm doesn't have extra cash. So the bank sells into a market that's already falling, which pushes prices lower, which triggers another firm's margin call, which causes more forced selling, which crashes prices further. It's a financial avalanche. And here's what makes you angry when you really understand it: you could be doing everything perfectly, no leverage, no panic, boring steady contributions to your boring index fund, and your balance still gets cut in half because of a chain reaction set off by over-leveraged hedge funds you've never heard of. Your collateral damage was their calculated risk. And then, right as it feels the most terrifying, right as every TV screen is flashing red and your stomach is in knots, that's the exact moment the wealth transfer happens. Every single sell has a buyer on the other side. When you panic and unload your index fund at 3 a.m. because your phone just told you the market dropped 20%, a computer algorithm, or a fund manager who has been quietly waiting for exactly this moment with a pile of cash, buys your shares at your panicked price. And then they ride it back up while you sit in cash wondering when it's safe to get back in. By the time it feels safe, you've missed 40%, 50%, sometimes 60% of the recovery. That's not a guess. That's what the data shows, crash after crash after crash. The forced selling mechanism isn't something you can stop. But understanding it gives you one crucial advantage: you can choose not to be the one being forced. And that starts with the crash cushion we'll talk about at the end. The currency time bomb inside international index funds. This one catches a lot of people completely off guard. And it's especially relevant now as more Americans branch out into international index funds to chase growth in emerging markets or Europe. Here's the thing nobody puts in the brochure. When you buy an international index fund as an American, you're not just making one bet. You're making two bets simultaneously. You're betting that the foreign stocks go up. And you're betting that the foreign currency stays strong against the US dollar. You can be completely right on the first bet, the stocks go up 10%, and still lose money because the second bet went against you. Here's a real example to make it concrete. Imagine you buy a fund tracking Japanese stocks. Over the course of a year, Japanese stocks rise 12%, a solid return. But during that same year, the Japanese yen weakens 18% against the dollar. When you convert your gains back into dollars, you've actually lost about 6%. The Japanese market did well. The companies were profitable. But your money went backwards because of currency moves that had absolutely nothing to do with the health of those businesses. This is a risk that is largely invisible until it hits you. Currency markets are driven by central bank policy, geopolitical shifts, interest rate differentials, forces that are wildly difficult to predict even for professional traders. And your international index fund does nothing to protect you from them. You are fully exposed. And it works in reverse, too. A weakening dollar can boost your international returns. But the unpredictability cuts both ways, and for most retail investors, that extra layer of volatility is something they never signed up for. If you hold international index funds, it's worth asking, do you own any currency-hedged versions? They typically have slightly higher expense ratios, but for large international allocations, they can smooth out a lot of volatility that has nothing to do with actual business performance. The bond fund blind spot that shocked millions in 2022. Quick show of hands, metaphorically speaking. How many of you have bonds or a bond index fund in your portfolio because you were told it's the safe part? Yeah. Most people. Here's something that shocked millions of Americans in 2022 and barely got explained properly in the aftermath. One of the most popular bond index funds in the United States, a fund that tracks the broad U.S. bond market, the kind of thing financial advisors have been putting retirees into for decades, fell over 13% in 2022. 13% in a single year. In the supposedly safe part of the portfolio. How does that happen? Bonds and interest rates have an inverse relationship. When interest rates go up, existing bonds become less valuable because new bonds are being issued with higher, more attractive yields. Makes sense, right? Now here's the critical difference between owning an individual bond and owning a bond index fund. If you own an individual bond, you can just hold it to maturity and get your money back. The price might drop on paper, but you collect your interest payments and eventually get your principal returned. The temporary drop doesn't have to become a permanent loss. A bond index fund can never do that. It doesn't hold bonds to maturity. It constantly sells older bonds and buys new ones to stay in line with its target index. So in a rising rate environment, it's constantly selling bonds that are worth less than they were before, and locking in those losses in real time. You signed up for safety. You got continuous, automatic, forced selling into a declining market. This is not an argument against bond funds entirely. They still serve a purpose in a balanced portfolio. But treating a bond index fund like a savings account, like guaranteed stability, is a misunderstanding of what it actually is. And in 2022, that misunderstanding cost a lot of retirees who couldn't afford it. The 3 questions that separate smart index investors from sitting ducks. Everything we covered today isn't meant to scare you. It's meant to give you something better than blind optimism, which is actual understanding. So here's your homework. 3 questions. Answer them honestly before you open your brokerage app again. Question 1, am I actually diversified, or do I just feel diversified? Look at what your index fund is actually holding. If the top 10 companies make up more than 30% of the fund, you have concentration risk whether you realize it or not. Consider complementing it with an equal weight fund or adding some international exposure. Question 2, do I have a crash cushion that exists completely outside my investment accounts? 3 to 6 months of living expenses in a high-yield savings account. Not your investment account. Not your 401k. A separate, boring, liquid savings account. This is the thing that means you will never be forced to sell at the worst time because life happened. Build this before you invest another dollar in the market. Question 3, is my safe money actually safe? If you're within 10 years of retirement and you're holding bond index funds as your conservative allocation, make sure you understand what rising interest rates do to those funds. A portfolio that felt balanced in 2020 might be carrying more risk than you think. Index funds are brilliant tools. Cheap. Simple. Effective over the long run for most people. But a tool you don't fully understand is a tool you can't fully trust. And you deserve to trust your retirement. Here's the one thing I want you to do after this video. Go look at your index fund holdings right now. Find out what the top 10 companies are and what percentage of the fund they represent. Just that one thing. Because knowing that number, actually seeing it, changes how you think about your diversified portfolio. And that awareness is the first step toward building something you won't panic out of when things get rough. If this gave you even one thing you didn't know before, share it with someone who needs to hear it. Most people are going to find out about these risks the hard way, mid-crash, with real money on the line. You found out today. That's the advantage. Hit subscribe if you want to keep getting financial truth delivered straight, no fluff, no hype, no products to sell. I'll see you in the next one.